Hello and welcome. If your business has ever paid for something upfront in, say, euros or yen, you've definitely run into a tricky accounting problem. Exchange rates are always moving, right? And even a tiny shift can mean a big difference on your books. Well, today we're going to demystify the official rule that finally solves this exact problem, a little thing called IFRIC 22. So let's just dive right into a scenario that is a classic headache for accountants everywhere. Imagine you pay a big deposit on some equipment in euros back in January. By the time it finally shows up in June, the euro's value has changed. So which rate do you use? The one from January, when you paid, or the one from June, when you got the goods? The answer, as you can imagine, has a huge impact on your financial statements. And this isn't just some made-up problem. The official committee that clarifies these international accounting rules was asked this exact question. And why? Because companies were handling identical situations in completely different ways. That kind of inconsistency makes it basically impossible for investors to get a clear apples-to-apples comparison. Okay, to really see where the confusion was coming from, let's walk through a super simple transaction. We've got a US company, they report everything in good old US dollars, and they're buying a specialized machine from a company in Germany. The price tag is 100,000 euros, and they agreed to pay half of that, 50,000 euros, upfront as a deposit in the middle of January. Now look at this. On January 15th, when they paid that deposit, €1 was worth $1.08. But fast forward to June 1st, the delivery date, and the euro has gotten stronger. It's now worth $1.12. You might think, 4 cents, what's the big deal? But on a massive transaction, that little difference can add up to thousands and thousands of dollars, creating a pretty big hole in the books. So, faced with this problem, where would an accountant look for an answer? Well, naturally, you'd turn to the official rulebook, the International Financial Reporting Standards. But here's the twist. The existing guidance was actually the source of all the confusion. You see, the main rule, a standard called IAS 21, said you should use the exchange rate on the date on which the transaction first qualifies for recognition. Okay, but what on earth does that actually mean? It's surprisingly vague for such an important rule. And that's the million-dollar question, isn't it? Is that date of the transaction the day you actually paid the cash deposit, or is it the day the machine arrived and you formally put it on your books as an asset? Without a clear answer, two companies could make the exact same purchase and end up with totally different values on their financial statements. And for an investor trying to compare them, that's a huge problem. So, to finally solve this ambiguity once and for all, the IFRS Interpretations Committee stepped in and issued a very specific clarification. It's called IFRIC 22, and it deals with foreign currency transactions in advance consideration. And this new interpretation was designed to be like a surgical strike. Its entire purpose was to just cut through all that messy, confusing language from the old rule and create one single, consistent standard that everyone has to follow. No more guesswork. All right, I know, the official language here looks a little dense, but the magic words are right at the end. Initially recognizes the advance consideration. In simple terms, this totally shifts the focus. It moves it away from when the goods arrive and puts it squarely on the moment you first account for the payment itself. So let's boil it all down. The crucial takeaway is this. The exchange rate is locked in on the day you make the advance payment. Period. The date the cash leaves your bank account is the date that sets the rate for that chunk of the transaction. It really is that simple. Okay, so let's go back to our example and see how this actually works in the real world. We're going to apply the nice, clear guidance of IFRIC 22 to our US company buying that machine from Germany. So under the new rule, it's straightforward. The company takes its 50,000 euro deposit, applies the exchange rate from January 15th, which was 108, and boom, they record what's called a prepayment asset on their books for $54,000. And that rate, it is now locked in forever for that specific payment. Of course, you're probably thinking, well, that's fine for one payment, but big international deals often have more than just one deposit. So what happens if the company made several payments on different dates when the exchange rate was bouncing all over the place? Well, IFRIC 22 has a beautifully simple answer for that too. You just treat each advance payment as its own little mini transaction. So the payment made in January gets recorded using the January exchange rate. The payment in March uses the March rate. Each individual payment locks in its own historical rate. Simple and clean. Now, like a lot of accounting rules, this one has a very specific scope. So it's really important to know that it doesn't just apply to every single transaction that involves a foreign currency. So you're going to use this rule for any advance payments for things like physical assets. Our machine is a perfect example, or for services you're paying for upfront. But it carves out some key exceptions, things that are measured at their current fair value, plus stuff like income taxes and insurance contracts. They're all handled by their own separate specific rules. So, we've been deep in the accounting weeds here. You might be wondering, okay, but why does a seemingly tiny clarification like this have such a big impact on global business? Well, its effects are actually incredibly important. You see, it all comes down to trust and clarity. This one rule creates consistency, which stops companies from, say, picking and choosing dates to make their numbers look better. That consistency leads directly to better comparability, so investors can actually judge one company fairly against another. It just wipes out the ambiguity and makes sure the financial statements are telling a more truthful story. And really, that's the bottom line. IFRIC 22 is all about leveling the playing field. It takes what used to be a subjective judgment call and replaces it with a clear objective rule. It makes sure that when it comes to these kinds of international prepayments, everybody is playing the exact same game. It just goes to show you how a single sentence of clarification in an accounting rule can literally affect billions of dollars in global trade. It creates more stable, more reliable financial reporting for all of us. And it kind of leaves you with a question, doesn't it? What other seemingly tiny rules are out there quietly shaping the entire world's economy?